So, good evening, everyone. Welcome to the class on investment management. So, in the previous class, I was discussing two-stage growth rate model, and we did one numerical also on two-stage growth rate model. So, we did that numerical on two-stage growth rate model. We did one numerical also growth rate model. We did this. Now, the thing was that 1 minute, 1 minute. Okay, guys. So you remember this numerical we did last class. So this is a numerical based. This is a numerical based on two-stage growth rate model. This comes every year. So, which year is this? This is which year is this? This is July or June 2018. You can see this. Now, if I open January 2019 also, so, January 2019, okay, January 2019 also, this numerical came. You can see the question number third, part B. So the purpose of telling you this is that this concept is very important. In the talk about when we talk about the valuation model of ordinary share, again I'm just repeating the fact that it is difficult to value an ordinary share. Why it is difficult to value an ordinary share? That it is difficult to value an ordinary share because in the case of ordinary share, the payment of dividend is not fixed. Okay, so it's up to the company. If the company want, they'll give dividend. If they don't want, they will not give dividend. And then next thing is that whenever the company give dividend, also it's not good for the company long run, because ultimately their internal equity get reduced because of the payment of dividend. And tomorrow, if the company may need money, so then they need to be go outside uh, the market to raise money, and then it's not good for the investor. So that if the company look for external financing options, either in the form of equity or debt, both way it's not good for the shareholder. So that's why it would be important for the company to maintain an internal equity. Internal equity is maintained through reserve and surplus, and reserve and surplus is maintained every year by retained earning, and retained earning is the part of the earning which the company retain with themselves, which they will know as a dividend to the shareholder. So as an investor, we should not expect dividend from the company. Okay, so it would be good if the company does not give dividend. So then ultimately the valuation of the ordinary share become very complicated, because the model what I'm discussing right now, it is a constant dividend growth rate model or a constant dividend model. In these models, what all I'm discussing, I'm assuming that every year the company gives dividend. So the overall idea of working on this model is that the company is giving dividend year on year basis, and then we are finding the present value of the dividends, and that is what we have done. So if you remember the last two classes, what I am doing, I'm basically talking about first model, that was constant dividend model. Then I talked about constant dividend growth rate model. Now I'm talking two-stage growth rate model. So why it is called two-stage growth rate model, I hope you can understand. So why it is called two-stage growth rate model, you can understand if you see this problem. So the current dividend of the company share is 2.75. The current dividend of the company share means the current dividend of the company share is rupees 2.75. And then the forecast is that the earning and dividend of the company will grow for 8% for next 5 years. So the assumption is that the next 5 year, assumption is that the next 5 year the dividend will grow. For the next 5 year, the dividend will grow at 8%. The dividend will grow at 8% per annum. So the forecast is that the dividend will grow at the rate of 8% per annum. And then after 5 year, it will grow at 5%. And then after 5 year, and then after 5 year it will grow, and then after 5 year it will grow, then after 5 year it will grow at 5% per annum. So I hope you can understand. Here two growth rates are mentioned. So here two growth rate is mentioned. This 8% I'll call as G1, and 5% I'll call as G2. Okay, so understand this. So here this 8%, I'll call this 8% as super normal growth rate. So we'll call this 8% as super normal growth rate. This 8% what you see, which I'm calling a G1 as the super normal growth rate, and then 5% I'm calling as a constant growth rate, and 5% I'm calling at a constant growth rate. Okay, so this I'm calling a G2. So you can understand here two growth rates are mentioned. That's why I'm calling this as a super normal growth rate. That is the reason why I'm calling this as a not super improvement. It's like I'm calling a two-stage growth rate model. That's why I'm calling this as a two-stage two-stage growth rate model. That's why we're calling this model as a two-stage growth rate model. That's why we're calling this model as the two-stage growth rate model. That's why this model we called as the two-stage model. That is the logic of calling this a two-stage growth rate model. I hope you're getting the logic. Okay, and the last class what I did, I did step by step calculation. I'm really doubtful that how many of you have understood the step by step calculation. So I'm really doubtful on that part. So I thought to discuss again this question. So I'll tell you the formula for that, so that you don't have to struggle. So I'll tell you direct formula to get the answer for this kind of question. So, and here the cost of equity, you can see the cost of equity is 20%. You can see the cost of equity required rate of return that we call as cost of equity as 20%. So here in this question, the current dividend is 2.75. The current dividend is 2.75. The growth rate, a super normal growth rate is 8%. Supernormal growth rate is 8%. Constant growth rate is 5%. Constant growth rate is 5%. Cost of equity that is given 20%. Okay, and the time period n is 5 years. 5 year for next 5 year. For n is 5 year. N is 5 year. Okay. Anyone have any doubt? Anyone have any doubt? Any question you want to ask? Anyone have any question? Any doubt to ask? Anyone, any question you want to ask? Okay, I hope you're understanding. So I hope you read this problem. So everyone, please read this problem. If you have not read the problem till now, so please read this problem once. One thing, be careful when you are solving the problem. Only one thing, very careful when you solve this problem. Be careful looking at the dividend. The dividend is a current dividend or next year dividend. So if it's current dividend, then it is DIV naught. Next year dividend means DIV one. DIV one is DIV naught into 1 plus G%. Be careful in exam when you get the question. Be careful looking at the rate of looking at the value of dividend. Is it current dividend or next year dividend? Anyone, any doubt? So I'll tell you the direct formula. So whenever you get two-stage growth rate model, I'll tell you the direct formula which will give you the answer directly. If you people are good in memorizing, then you can memorize. Otherwise, logically, if you want, last class I did logically, but I'm really doubtful how many of you are very much satisfied with the logical reason. So div naught 1 plus g1 divide by ke minus g1, okay, into 1 minus 1 plus g1 divided by 1 plus k to the power n. Okay, then plus div naught into 1 plus g1 to the power n into 1 plus g2 to 1 plus g2 divide by e minus g2 and then 1 plus k to the power n. So you have to remember this formula. So this formula is there. You have to by heart this formula. So with this formula, this is the formula for two-stage growth rate model. So, so for two-stage growth rate model, use this formula. So for two-stage growth rate model, use this formula. This is the formula which you have to by heart. Okay, now understand the parameter and be very careful with the dividend, that is it the current dividend or the next year dividend. So if it is current dividend, then you use div1. Okay, be very careful with the dividend value. Okay, any doubt anyone? Now it's very easy. You just need to substitute the value. So the price of share equal to 2.75 into 1 plus G1. G1 is 8% divided by K. K is 20%. G1 is 8%. Then 1 minus 1 plus G1 8% divided by 1 plus K 20% to the power 5. N is 5. You can see plus 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 div naught. Div naught is 2.75. Div naught means current dividend. 1 plus 8% to the power n. To the power n. To the power n. N is 5 year. No? 5 year into 1 plus 5%. Then k is 20% minus 5%. Then 1 plus k to the power 5. So this is what you need to solve. I hope everyone can solve this very easily. So this is 2.75 into 1.08. This is 12%. 12% I can write 0.12. This is 1 minus 1.08 divided by 1.2 to the power 5 plus the power 5. This is 1.05. This is 15%. 15% I can write 0.15 into 1.2 to the power 5. Anyone, any doubt? Anyone, any doubt? Are you understanding though? What is N? N is the time when the supernormal growth rate get over. Use this formula, you'll get the answer very easily. So use calculator everywhere. This is 2.75 into 1.08 divided by 0.12. Sorry, 0.12. That is 24.75. 24.75. 1 minus 1.08 divided by 1.2, that is 0.9 to the power 5, that is 0.5909 plus plus solve step by step. 1.08 to the power 5 into 1.05 into 2.75. This is 4.42684 divided by 1.2 to the power 5 into 0.15. That is 0.373248. Anywhere, any doubt? Everyone do this much. Ask me if you have any doubt. Ask me if anyone want to ask anything. 1 minus 0.59049 into 24.75. So that is 10.1353725 plus 4.242684 divided by 0.373248. You get 11.36693. This plus 10.1353, you get around 21.5022. Very good, Rajita. Okay, anyone, any doubt? So after yesterday class, like last class, I decided that if I do step by step, you people will not find it much interesting. So I thought better to tell you the formula because this is coming for your exam. It would be good if you can understand step by step. Otherwise, you remember this formula, you get the answer. I believe so. These things were there in your second semester also. Anyone, any doubt? Anyone, any doubt? Any question you want to ask anyone? So no one is replying anything. So I'm assuming that you have understood. Can we go to the next question? Prajwal, done. Suraj, Akash, Divya, Karthik, Mohan, Prakriti, Priyanka, Rakesh, Ravi Teja, Sakib, anything you want to ask? Chaitanya, Shalini, Virendra, anything you want to ask? Sir, I got 1.70 in place of 1.2. Uh, uh, 4.2, Yogeshwari, please understand Yogeshwari, how will you get 1.70? Because Yogeshwari understand, if you multiply them, Yogeshwari, so anything if you multiply with 2.75, and if that something is more than 1, then you get a value more than 2.75, Yogeshwari. You can never get the value less than 1. Try one more time, Yogeshwari. I think some calculation mistake is there. Anyone, any doubt? Any doubt, anyone? Can we go to the next question? Okay, so let's do another problem. Okay, let's do another problem. You can see this question. You can see this question. So the current dividend on an equity share of ABC Limited is 3 rupees. Be careful on this word. Read this word again. Very careful. Is this current dividend or next year dividend? Be very careful. So the current dividend is 3 rupees. Then C question. This Ranjita, are you talking about this one? This EMA C means is this is third one. If you're talking about this is EMA, exponential moving average. That is under technical analysis. I have not taught that. See, Ranjita. So, like, understand, Ranjita. You can do this question. This question, what you see, you can use this question either by direct formula you can solve, or you can solve by the step by step. This direct formula is actually derived from that only. So you are good with mathematics, so you understand GP. So GP only I derived this formula with through which I'm solving this problem. You do anyway, Ranjita, you will get the same answer. I'll show you. I'll show you both the way. Then you will get confidence. So the current dividend. So both mean same thing only. So both mean same thing only. So only thing I realized that you people will love if I do with a formula instead of doing step by step. So many people will not like so much. They feel that it become very. So that's why I derived this formula I'm doing for you. So after every class, I think about everything. So on that basis, I decided let derive this formula and give this formula to you, so that you people will be easy for to solve. So the current dividend is 3 rupees. ABC is expected to grow an above a normal growth rate of 20%. So again, so G1 is 20% for the period of 6 years. So the time is 6 years. So 20%, this is super normal growth rate, 20%. Thereafter, the growth rate will stabilize to at 10%. So G2 is 10%. So this is constant growth rate. This we call as super normal growth rate. This we call as super normal growth rate. We call this as super normal growth rate. And this we call as the constant growth rate. This we call as constant growth rate. Okay, so thereafter the growth rate will fall at 10%. Equity investor requires a return, means KE. KE is 14%. Okay, what is the intrinsic value of share? So again the same formula. Again the same formula. Only thing you have to buy hard the formula. If you can buy hard, then your work is done. So the price of share. So the price of share is equal to DIV naught into 1 plus G1 divided by KE minus G1 divided by K minus G1, 1 minus, this is derived from GP, 1 plus G1 by 1 by K. K means cost of equity to the power n plus DIV naught into 1 plus G1 to the power n into 1 plus G2 divided by K minus G2 into 1 plus K to the power n. So this is the formula. So the price of share, so the price of share DIV naught is, what is DIV naught? 3 rupees. 1 plus G1 is 20%. K is 14%. So 14% minus 20%. 1 minus G1 is 20%. K is 14% to the power, how many years? 6 years, plus DIV naught 3 to 1 plus 20% to the power 6, then 10%, then 1 plus 10%, then K is 14% minus 10% into 1 plus K. 1 plus K means 1 plus 14% to the power 6. So the price of share, when you talk about the price of share, the price of share is equal to 3 into 1 plus 20% means 1.2. 14 minus 20 is minus 6%. Minus 6%. This is 1 minus 1.2 divided by 1.14 to the power 6 plus 3 into 1.2 to the power 6, 1.1 divided by 14 minus 10 is 4%. 0.04 into 1.14 to the power 6. So now the price of the share. So the price of the share is equal to this 3 into 1.2 to the 12 3s are 36 divided by minus 0.06, 1 minus 1.2 divided by 1.14. So So 1.2 divided by 1.14, that is 1.05263 to the power 6 plus 3 into this to the power 6. So this is, leave that part, the power 6, that is how much, 1.360374, 374, this much. So this is 1.2 to the power 6 into 1.1 into 1.1. This is 3.8458 something. 1.2 to the power 6 into 1.1. Divide by 1.14 to the power 6 into zero point zero 0.04. So this is 0.0877, 0.0877989. So this is 3.6 divided by 0.06. So this is minus 60. This is 1 minus 1.360374 plus 0.05263 to the power 6, 1.36037 plus this is 3 into 3.28458 divided by 0.0877989, that is 112.23079. The price of share, so that is equal to, so the price of share is equal to minus 60 into 1 minus 1.360374. So this is minus 0.360374, 360374 plus 112.23079 into minus 60. So you will get the price of share as 21.62242 plus 112.23079, 112.23079. So you will get the price of share as 133.853, something like this. Clear everyone? Anyone have any doubt? Clear everyone? Mohan, Tajwal, Ravi, Sanjay, Shakib, Suraj, Virendra, Yogeshwari, Chaitanya, Shalini, Prakriti, Priyanka. Any doubt, Rakesh? Anything you want to ask? Ranjita, you got the answer? 133.853. Mhm. Clear everyone, right? So you can solve this step by step if you want. You can solve this question step by step. Okay. So can I show you step by step calculation? The same question if I do in Excel. So you can see the year. You can see the year. 1, 2, 3, 4, 5, 6, 7. You can see the year. This is dividend. Future value of dividend. Hmm. Then cost of equity. So you can see that the supernormal growth rate is 6 years. So take 1 year more than that. Okay, cost of equity is 14%. So you can write here 14%. You can write here 14%. Okay. Current dividend is 3 rupees. So the current dividend is 3 rupees. Current dividend is rupees 3. The current dividend is rupees 3. Okay. Okay. The supernormal growth rate, you can see the supernormal growth rate, supernormal growth rate is 20%, and the constant growth rate is 14%. So constant growth rate is 10%. Constant growth rate is 10%. Hmm. So future value dividend. So how will you find future value dividend is current value dividend into 1 plus what is the supernormal growth rate? This is growing for how many years? 6 years. No? You can find the every year on year basis. Okay, you can directly do this. So what I can do this. into 1 plus your growth rate, supernormal growth rate. On year basis you can do. Okay, year on year basis like this you can do. Year on year basis you can find your supernormal growth rate. Now from seventh year what is happening? From seventh year what is happening? Now seventh year it is growing at the rate of 10%. From seventh year it is growing at the rate of 10%. From seventh year it is growing at the rate of 10%. Now whatever are the supernormal growth rate, for them find the present value. Whatever are your supernormal growth rate, find the present value of dividend. Find the present dividend. Find the present value of dividend. So this you get. Find the present value means this value divided 1 plus 14% to the power 1. Find the present value of dividend. Now this is the present value. This is the present value of share under supernormal growth rate. Under supernormal growth rate. Under supernormal growth rate. So that is the sum of these values. You can see this is 21.62245. So you can see this you can see this that part. See this 21.62244. See the same thing. I hope you're getting the logic. Same thing. This is 21.62245. See 21.62245. So either manually you do the sum. Either manually you do the sum like the way I've done right now. Either manually you do the sum like the way I did just now in front of you, like the way. Only thing is that when I do with calculator this one by one, you people will not be that much concentrated. That's why just to show you this, I'm just doing it like that, like the same way. So either you do like this or you apply the formula that div naught 1 plus g1 divided by k minus g1 into 1 minus 1 plus g1 by 1 plus ke to the power n. Both will give you the same answer. Okay, anyone have any doubt? Anyone have any doubt? Anyone, any doubt? So nobody is saying anything, so I'm assuming that you are understanding. So this is supernormal growth rate. So this is the formula. So directly either you can use this formula or you can do step by step. So Ranjita, I hope you are understanding. So this was your question. So you can do any way. Both will give you the same answer. Mohan, your webcam is on. Mohan, it would be great if you can switch off your webcam. So you do anyway, you will get the same answer. So I hope you got the logic. Now what happens? Now what happens that from seventh year, if you understand from seventh year, if you understand from seventh year, if you understand from seventh year to infinity, from seventh year to infinity, the stock is following from seventh to infinity, from seventh year to infinity. stock is following from seventh year to infinity. Stock is following constant growth rate model from seventh year to infinity. The stock is following constant growth rate model. The stock is following constant growth rate model. If you remember, the constant growth rate model formula was P naught is equal to div1 divided by ke minus g. If you remember, we did very recently the constant growth rate model formula, constant growth rate model formula. For that, under that we studied the p value is equal to div1 divided by k minus g. This is the formula for constant growth rate model. Okay, so this is the formula for the constant growth rate model, that the present price of share, that the present price of share is equal to dividend for the next year divided by k minus g. Okay, you have to understand that in this problem, you have to understand in this problem the constant growth rate. You have to understand in this problem the constant growth rate is starting from seventh year. If you understand, so the constant growth rate here is starting from seventh year. So that's why if I'm writing the dividend for the seventh year, so dividend for the seventh year means it will give me the price for the sixth year. The dividend for the seventh year is equal to price for the sixth year divided by k minus g2. This will give you the price for the sixth year. This will give you the price for the sixth year. So the price for the sixth year is equal to a dividend for the seventh year divided by ke minus g2. Okay, but for solving the problem, we need the present price. No, but for solving the problem, you need the present price. Okay, so this formula, constant growth rate model, will give you the price at the end of the sixth year. The constant growth rate model will give you the price for the sixth year, but for this question, I want the present price of the share. So mathematically, you know that P6 is equal to P naught into 1 plus KE to the power 6. You can say that, and the price of the share after sixth year is the present price into 1 plus KE to the power 6. Everyone knows now basic mathematics. Future value is equal to present value into 1 plus R percent to the power T. So what I can do, what can I say? So I can say that, so I can say that the present price of share is equal to present price of share. So I can say that present price of share is equal to price after sixth year divided by 1 plus k to the power 6. Okay, now price after sixth year is, this is the formula. Price for sixth year, this is the formula. The price for the sixth year, this is the formula. So what I'll do, I simply substitute. Then it becomes dividend for the seventh year. Dividend for the seventh year divide by minus g2 divide by k minus g2 into 1 plus k to the power 6. That will give you the present price of the share. Okay, so dividend for the seventh year means, dividend for the seventh year, how will you get? That already I have determined by step way. Okay, so then k minus g2. So here I got, so here what can I do? I hope you got the logic. So the dividend for the seventh year, so the dividend for the seventh year already I got. Okay, now k minus g2. So now k minus g2. Now k minus g2. So now what you can do? So now I can find the, so now I can find the if I find the price of share after 70, so the price of share after sixth year is equal to price of share after sixth year, that is equal to the dividend for the seventh year, that is equal to dividend for the seventh year, that is equal to dividend for the seventh year divide by constant growth rate model. So divide by KE. What is KE? KE is 14%. KE is 14% minus what is G2? G2 is 10% minus G2. G2 is 10%. So if you solve this, so you got the price of share after 6th year, but I want the present price. What is the price of share? Present price, present value of share, present value of share under constant growth rate model, under constant growth rate model, under constant rate model, under constant growth rate model, that is equal to, you have to find the present value of this divide by, find the present value of this divide by 1 plus k. K is 14% to the power 6. So you're finding after 6 years. So just solve this. You will get 112.112.3 So 112.2309. 112, you can see this part. 112, you can see this. 112, you can see this. 112, I hope you can see this. So what we did, so 112, this the same thing. So 112.23.23079. So once you get that, so what is the present value of share? Once you get that, now you find the present value of share. So the present value of share is equal to, that is nothing but it is the sum of this value plus the value of this value. That is 133. So this is the present price share, 133.853. Clear everyone? Anyone have any doubt? So I can do this. I could have done the same thing in the notebook and then try to give you the answer, solving step by step by using calculator. But many of you don't like and you don't have that much patience also. That's why, just to prove that thing in your mind, I just did it like this way. The purpose is that you can easily find the value and all. So what matters here is the approach, how you're gonna solve the problem. It doesn't matter it is two-stage growth model or three-stage or four-stage. By using step by step, you can get the answer for any problem. Any doubt, anyone? Anyone want to ask any question? Anyone, any doubt, any question you want to ask? Any question anyone want to ask? So if nobody is asking, assuming, I'm assuming that you have understood what all I have taught till now.